Hi, hello. Welcoming you all for the eighth episode of the Alternate Universe. This is Akshara Menon, analyst at PMS Bazaar. And today's topic that we're going to discuss is wealth and asset management, a comprehensive exploration of opportunities and challenges. So let's wait for less. And the guest for the day is Mr. Karan Bhagat. There are a lot to talk about him, but I'm just keeping my introduction as precise as possible. Mr. Karan is the founder, MD, and CEO of 361, which is formerly known as IIFL Wealth and Asset Management. Mr. Karan, as a professional entrepreneur, set up a company in 2008. In a short time, he has built a team of more than 1,000 professionals who today manage money more than 6,800 top families in India. Under his leadership, 361 has grown from its humble beginnings to beginning of the leading wealth management company in India, managing around 383 crores in client assets. Mr. Karan was featured in Fortune India's 40 under 40 list in 2016 and 2017, and Economic Times under 40 under 40 in 2017. The Wall Street Journal published the 2020-22 CEO Council Roll Call, which features Mr. Karan in the world's most influential decision makers list, a network of chief executives driving the future of business. Mr. Karan has been recognized as Asia's promising business leader by the Economic Times. Moving on to the next person of the day, Mr. Vikaas M. Sachdeva, who is not a new face to us. Mr. Vikaas M. Sachdeva is an industry stalwart with over 3 decades of experience in asset management business, who is currently managing director of Sundaram Alternates Limited. So moving on to the next person, Mr. Madanagopal Ramu, head equities and fund manager with over 15 years of experience in Indian financial markets. He currently manages the AUM around INR 350 3,500 crores PMS and AIF platforms under Sundaram Alternates. Thank you, sir. So over to you, sir.
Thank you, Akshara, and welcome, Karan, to the show. The last time I spoke to you, Karan, I think it was, 18 months ago, 15, 18 months ago on a show like this. And I was just reflecting that a lot of water has flown under the bridge. Last time I spoke to you, you were still a private limited company, and this time you're a public limited company. Okay. And I have to be mindful about that. So some of the questions which the audience has asked, which we are going to ask, assuming it doesn't go well with the code of conduct of public limited companies, please feel free to let me know. But on that note, I should also tell you that one thing which has also not changed is the amount of due diligence we've done on you. Okay, since you're a public limited company, I'll call it due diligence instead of research. And I'd just like to share that with you. I'm just wanting to introduce to the audience the person behind the professional, the person who Karan Bhagat really is. Your entrepreneurial journey started with your own travel agency at the age of 17 in Kolkata. I think this is something which has been fairly well chronicled. Also, the fact which is of particular interest to me is you actually taught young aspirants for CAT examinations at one point of time. I remember that conversation very clearly. But, one of the things you keep describing yourself as is that you're a not very sales-oriented person and you learn through your experiences. I must tell you, this thought of yours, a lot of people don't agree. To start with your friends disagree vehemently. They think that you are the life of every gathering and you love to go out and meet people. In fact, your colleagues to some extent would also disagree. While I was talking to them, several adjectives have come to the fore. Trustworthy, he always has your back, always client first, workaholic, very accessible. But what the most common words I've heard people describe you is they're extremely humble. Humility is your forte. It's actually what defines you as a person and what you really are. And I think as a professional who's been interacting with you over the years, I can second that. They also talked to me about how you give them enough freedom to operate. You don't micromanage things. You allow views to be shared very, very openly. In fact, they think that it is a refreshingly candid discussion at times they have with you, and they can do that because they don't fear being judged. They don't fear being judged. But equally, when the time arises and there is a situation, you are absolutely capable of being very hands-on and you will get into the trenches yourself with folded sleeves if the need arises. When you have your own points of view, it is known to them that you probably spent hours of deep research or have got industry insights by talking to a lot of people, and that is how you're coming to a particular point of view. But if you actually get a counter view with data and logic, you're very open to just changing it gracefully and then moving on. As a person, you prefer reading old classics like The Intelligent Investor. But one of the more interesting things people talk about you is you keep yourself current more so by meeting people and talking to them. And that is your way of staying current and enhancing your knowledge continuously. You are one of those people who's never afraid to express ideas in public. In fact, a few audience questions have actually come in asking for your ideas, asking for your vision. And one of the more important things you always believe in is execution is more important than the idea. Idea may be something which can come to few people at the same time, but execution is something you really are, you are really focused on. And by virtue of the fact that you have a lot of confidence in executing an idea, you don't mind talking about it in public. You're usually a very chilled out and lenient person to work with, but what actually gets your goat is when people give up and they don't put in enough effort according to you. Also, a lot of people have told me that you have zero tolerance towards somebody who is not honest or integral and does not have integrity in the overall functioning. You must probably not have realized the moment I saw you, I took off my tie. Okay. You're more comfortable dressing down than dressing up. You like to be more in casuals than suits. That is something which you really like. At a personal level, Karan, you're father to two wonderful twins, Kyra and Khush, who are 14 years old. Kyra is a judo champion and Khush is a chess prodigy, both doing well at national and global levels. Your wife, Shilpa, whom apparently you met when you used to teach at an institute way back in the day, is an influencer, a fitness blogger, a video creator, a motivational speaker, and is very actively involved with NGOs. As a family, when you take holidays, you always prefer beaches over mountains. You're an out-and-out water baby. But again, your colleagues say that even when you're on vacation, you're always accessible to them as well as your clients. One of the things you strongly believe in and you talk about quite often is that luck is one of the main factors in deciding one's success. Close to 80% of it is due to luck and 20% is about the ecosystem, the company you work for, the people you work for, and that actually keeps you grounded in terms of your functioning. Your poison is black coffee. You can have a black coffee at any time of the day, any time of the night. You love sports like tennis, table tennis, squash, cricket, but like a typical Kolkata person, which is where your origins are from, you love food. Okay, and you miss the rolls and the street food from Calcutta quite a bit. Lastly, you give back to the community by supporting and promoting sports like chess tournaments across the country. You also have been a strong supporter of girls' education and have been a catalyst for several of their well-being. It was fascinating talking to a lot of people around you, Karan, and this is what I've been having the pleasure of bringing it across to the audience. So thank you so much for gracing the show. As always, I look forward to your answers on some of the questions because I know you're going to be as candid as you always are.
Thanks, Vikaas. For the last 5 minutes, I was nearly feeling like a stock here. Well researched by Sundaram. So thanks a lot. Happy to be here. I'm obviously not going to take a lot of time talking about myself. I'll take 15-20 minutes and give a little bit of a introduction on the last maybe potentially 22, 23 years or maybe 26 years and what it's meant for me. Obviously, a lot of lessons learned along the way, and that's really what we are here to talk about. And after that, maybe 15-20 minutes, happy to make it as interactive as possible, and happy to take questions from you as well as the audience. And as far as in the middle, Vikaas, feel free to come in if you want, and kind of happy to be interjected by you and take it forward from there. So I think as I look back at life for the last 26 years, I think 3 or 4 things really kind of stare at me absolutely clearly. And I think one thing which really comes to my mind right at the beginning is adversity is the best opportunity. And I think at all points of time in my life, at least, I've ended up starting the best things when things are the worst. But the first experience for me really was in the year 96, when I was just getting into college, and my dad had to shut down his fabrication business because there was the Asian currency crisis in the year 97. And that was a big challenge, but the big opportunity was college in Calcutta was only 6 o'clock to 9 o'clock in the morning, and if you were doing commerce, you were expected to be at your dad's office at 9:30, 9:45, or doing your chartered accountancy. And 96 during first year of college, I ended up resulting in me starting my travel agency, and that was a very, very tough experience because it got me to sell tickets as a sub travel agent in Ezra Street, which is the cable market of Calcutta. And I got a relative of mine to put in 5 lakhs on commercial terms, which are essentially 5,000 rupees a month for me, and 18% return for him, after which we split 50-50. Obviously, with 5,000 rupees and 18%, we never got to the 50-50. But the learning experience of the 2 years was phenomenal, because as an individual who had to go and convince a cable operator, he always wanted a 5-6% cash discount out of the 7% commissions, or he wanted at least a 3-month credit to account for 2% interest cost per month, so that at least the 6 out of the 7 could be justified. And that compressed market, actually, to be able to go out there and make money was maybe one of my toughest learnings, which I ended up getting between 96 to 98 fairly early in life. As I graduated from campus, which was a phenomenal experience for me in 2001, I ended up getting a job in a company called Cluster Consulting in Barcelona. As life was to have it, my work permit took 6 months to come, and it finally came through on, I think, around about 20th of September 2001. In an institute called Erudite in Calcutta. And 2 great things happened to me because of this postponement. One, I ended up meeting my wife while teaching. And secondly, September 11th happened, and telecom and financial services obviously went downhill from there. And without going to Barcelona, I essentially got laid off. And the first 48 hours felt horrible, because the office was where the W Hotel is there in Barcelona right now, and I was already dreaming of the beaches. And jobs absolutely dried up in India in September, October, November 2001. Kotak actually was a day 3 company in campus, and in that year in IIM Bangalore, we finished all our placements on day 1. So effectively, Kotak as a company didn't get the chance to come to campus. So ended up joining Kotak Securities in 2001. It ended up being a phenomenal opportunity because in Delhi in 2001, Kotak was hardly known. My first 5-6 meetings were absolutely hilarious, and that's why I sometimes say I didn't want to be a salesman, because I called 2 or 3 corporate lawyers, and before I could say anything, the phone was banged on me. What we ended up doing was very, very interesting. We decided to go out searching for houses in Delhi which look large. And that one weekend changed my life in some ways. In December 01, basically me and 2 management trainees spent the weekend in a car searching for houses. And those days, you used to not have the advantage of a VC circle or a deal curry. So you basically noted down the address of the house and came back and searched for the phone number on the MTNL directory. And one weekend between Friends Colony West, Okhla Phase 1, and GK2, I actually ended up getting the 3 largest clients for me in my life, even after 22, 23 years. All 3 of them continue to be with us. W36 GK2, 5A Friends Colony, S101 Panchil Park. These are some of the addresses which we found on one weekend. But the next 3 months actually continued to amaze me, because out of the 20 meetings I think I did, at least 8 or 10 meetings, the clients thought we are coming from Kodak and not from Kotak, because nobody really knew the brand Kotak in 2001 in Delhi. Obviously, in Bombay, it was well known, but in Delhi, nobody knew. The remaining 10 were even more hilarious, because they thought we were coming from a security guard company, because it was called Kotak Securities. My size obviously didn't help. And the moment you entered, the security guard was potentially seeing that isn't his job on the line. So I think it ended up but being a great learning experience, because anybody who was willing to put up his hand and take responsibility got hold of a lot of responsibility. And I think my first responsibility really in Kotak in Jan 02, Feb 02 was to ensure that the office got shifted in time from the 9th floor to the 2nd floor, because we used to have a dealing room. And on those days, losing one day of brokerage meant a lot of loss of revenue to the firm. So essentially, moving the VSAT lines and so on and so forth from the 9th floor to the 2nd floor is really what got me integrated in the firm, because everybody in Bombay knew that if they had to check on the timeline of the transfer or the shift, they had to call me. And I think that 2001 to 4 in some ways was great. It also taught me the life of being a professional. And I was always a little number driven, and I started trying to do the maths on what does it really mean to be a professional. And I think in my own maths, in 2004, I thought I'll do something on my own. And when I was planning to do something on my own, I did the maths, and my boss helped me. We broadly did the maths for 100 rupees of revenue brought to the firm. And those days, private banking was very transactional, fairly commission oriented. So for every 100 rupees you earn for the firm, you get paid around about 15 rupees. We did the costing for the firm. So broadly on the 15 rupees being paid to me as a relationship manager, the firm was spending another 25, 30, 35 rupees broadly on branding, marketing, my boss, my super boss's salary. So effectively in total, there was a spend of 50 odd rupees against the 100 rupees. So if you looked at the maths, the firm was broadly earning 45, 50 rupees, paying taxes, ending up with 30 to 35 rupees post-tax. And we were essentially, as an employee, earning 14 to 15 rupees, paying tax, and ending up with 7 to 8 rupees. So broad equation was 1:4. So for every 8 or 9 rupees I was earning as an individual, the firm was earning 32 to 35 rupees. At the outside, it seemed fairly fair to me, because effectively what it meant is if I was to go out and do my own job or do my own business, I effectively had to do at least 25% of the business or of the revenue, which I would be doing sitting inside the firm. And honestly, as I looked at the platform and my ability to go out and do 25% of the business, it was clear it's not going to happen. And the learning and the offsites and the ability to go off for a holiday for 15 days, transfer work to somebody versus doing a fourth of the business, it was quite clear that I won't be able to do a fourth of the business. And therefore, I was in a good place. 2004, obviously, Kotak ended getting the banking license, and that essentially got me to Bombay. And that's when I started meeting smart people like Vikaas. And 2005 to 7 was a different client experience altogether. Because we suddenly, for the first time, I got exposed to the word P multiple somewhere in the year 2005, 2006. Stocks were obviously soaring. The real problem is the 32 is getting, in Kotak's case, it was getting multiplied by 30 times. So effectively resulting in 8 rupees is to 1,000 rupees. So suddenly the equation of 8 is to 32 or 1 is to 4, which was looking quite attractive, effectively on 8 is to 1,000, suddenly got me fairly unsettled and got me to rekindle back my entrepreneurship journey. Like every time in 2001, 96, I got my timing absolutely wrong. I put in my papers on 3rd Jan 2008. Pretty much timed the market to perfection, ended up being the peak of the market, and ended up starting business on 10th or 15th of April of 2008. Couldn't find a better time to start work. But again, we were phenomenally proud and egoistic in 2007, December, January, in the sense that we believed we could go out and do everything. Whatever we would touch would be gold. That changed very quickly in April 2008 for the better, where we all realized, it's a function of many things and many people to, maybe going out and taking offices on rent. We were 100% sure that we wanted to do it in a very modest and step-by-step manner, as opposed to going out and doing it in a gigantic manner. Second, obviously, I think it enabled us to hire people much easier in 2008, 9, 10, as opposed to maybe potentially 5, 6, 7. In more ways than one, I think it kept us fairly grounded, much more client-centric than we would have been in 5, 6, 7. And in retrospect, when I look back over the last 14, 15 years, I can't think of a better time to have started the business than in the middle of the crisis. So in some senses, 2008 was pivotal in my journey in being able to start. Second, I think second thing which I like to kind of always believe and not sometimes give myself credit and sometimes not give myself credit is, I think in reality, I think foresight is really 20% and hindsight is 80% in success. Very often as entrepreneurs, we start looking at it the other way around, where we look at success as being 80% foresight and 20% hindsight. But in reality, it's pretty much the other way around. I can't imagine. I think if you would have asked me on the day of my campus placements, one thing which I don't want to do, I would have told you I don't want to do sales. The only thing I would want to do is consulting. And fast forward in life, that's the only thing I'm doing in some senses. But honestly, I think if I was to look at attribution in terms of success, I think 60 to 70% of the attribution honestly ends up happening the country and the time and the industry you are in. It's very, very important because in the last 15, 20 years, hypothetically, my ability to change the industry is very, very small. My ability to, let's say, create wealth in a different country would have been substantially lower. So those things are really outside our control. And in some senses, we have to be very thankful for that 60, 70% working out well. The next 20% obviously is the ecosystem, the stakeholders. Everybody needs to come together. And that's also something which is, more often than not, 8 times out of 10, 9 times out of 10, any business with 3 partners and above has a close to 80 to 90% probability of failing, right? Not because of the business, but because the partners don't get along. So that 20% of, getting your entire ecosystem right, the company right, the people right, the alignment of interest right is also very, very important. But more often than not, what also happens is this 90% is common across all people, even in a firm. Let's say if you look at a firm, this 90% is the same for everyone. Okay, so everybody has exposure or benefit of the same 70%. Everybody has exposure and benefit of the next 20%. But finally, what distinguishes everybody is that last 10%. And all our businesses, to a certain extent, is fairly laborious. We are not really inventing anything. We're not scientists. We are innovating in some senses. We are improving on things. We are maybe improving on the product, improving on fees, improving on tax, improving on the process, improving on timing. And therefore, that last 10% becomes super critical because it's all about effort. So I think that's the last 10% which really distinguishes people. The first 90% in some senses becomes common. And that 10% is very, 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 very critical. But I think, generally speaking, the market is super competitive across the world and across the globe, and even in India. And I love to cite this example to a lot of people. There's a power of multiplication in our business. So effectively, any business, there's product and there's people, and all three need to come together for it to be success, right? For example, if I was to just look at private wealth, you could take the best people, but put them into a platform which is not complete, or doesn't have any products at all, and they're bound not to succeed. Similarly, if you take the best platform, but not have the best people, if I look at our own experience from 2008 to 13-14, we could have been doing phenomenally well in 2 or 3 locations and not doing anything at all in the remaining 3-4 locations. Now that's because the platform's the same, but effectively you don't have the best people in those platforms. So I think as markets become super competitive, these 3 end up becoming multiplicative functions instead of additive functions. So the best way I like to describe it is, 9 plus 9 plus 9 effectively is 27 on 30. 9 into 9 into 9 is effectively 729 on 1000.
Beautiful.
Right.
Beautiful.
So effectively in our world, scoring 9 on 10 on each of these 3 parameters than the next player, it doesn't really leave you 10% less efficient. It's not 27 on 30, it's really 729 on 1000. And therefore in our marketplace, you really can't be 9 on 10 on each of these parameters. It's something which the client sees through, and really becomes extremely, extremely tough to kind of match on as you kind of go forward. So I think that's something which is which I think has been very, very sensitive. And any quarter, any 6 months, any 9 months, we see one out of these 3 things failing. We end up kind of seeing our market share kind of go down to a certain extent. The 4th thing, which I think is very, very important, and especially as you move from small to big to large, right, is every business as such has 3 stakeholders. It has a promoter, investor, shareholder, whichever word you want to kind of use. Second, you obviously have the employee, the management, the CEO, the founding team, all of those. And third, obviously, is the client, right? So I think all these 3 stakeholders are critical to the business. And this relationship is very unique between the 3, because it's a paradoxical relationship, and yet needs to move together, right? If left to everybody, the promoters and the investors and shareholders would want to pay the employees and the management team the least. The management team and the employees would want to earn the most. Again, the firm would want to charge the client the highest. The client would want to pay the least, or practically do it for free. And it's really very important for any firm to succeed, that in this kind of a paradoxical relationship, they are able to get the alignment of interest right between these three stakeholders. And I think for us, from a culture perspective, this is one of the things which I personally feel we've done well. We've been able to align the interest between these three stakeholders in a very unique way. And in some ways, it's helped us shape our culture. And that's really what is going to lead to long-term sustainable success. I think if any one out of these three stakeholders become too powerful in balance, eventually it kind of leads to a fallout. Because if the investors and promoters end up keeping too much for themselves, you'll eventually have the founding team move out, or the other way around. So it's very important, and it's a core part of our business activity, where we need to ensure that these three stakeholders can move together in spite of being in a bit of a paradoxical relationship. The last point I'll kind of want to talk about a bit is really the power of compounding, which obviously all of us are aware about. But I'd like to spend 2 minutes on that in context of our business itself, right? So, and in context of being an entrepreneur rather than a context of our business. It's a lot of times people ask me, a lot of prospective employees also ask me, is most of the journey done, and most of the thrill, enjoyment, and most importantly, wealth creation already done from 2008 to 2022? And honestly, as an entrepreneur, when I look at it, it's extremely different, right? So if I just look at the journey and break it up into 3 parts, and unfortunately I'll have to use numbers here and market cap here, because there's no other better way for me to explain it. But if we started our business in 2008 as 6 individuals, between 2008 to 16, and I'm going to use 16 because that's when General Atlantic invested in the business. Our business, let's say, grew from 25 crores of equity in 2008 to, let's say, they valued the business at 4,000 crores. So the IRR between 2008 to 16 may be the highest, right? It may be, let's say, whatever, 40, 45, 50%. But on the flip side, the risk obviously we took was the largest. Between 9 to 13, at least there were 3 to 4 instances when we felt we may not end up doing the same thing after 3 to 4 years. Second, the probability of success is the lowest. At least 100 firms like us would have started, only 1 or 2 would have made it there. And third, I think just the certainty of achievement is the lowest, right? But having said that, the IRR is the highest, but the absolute return you make is actually the lowest. The risk is the highest, the probability is the lowest, and the absolute return is the lowest. Now, just from a market cap perspective, I was to just look at the entire team together, and let's say the entire team owns 10% or 15% equity. In that sense, the 25 to 4,000 crore journey represents whatever 400, 500 crores of wealth creation. 2016 to 22, I'm just going to call it as phase 2 of our journey, is, let's say, when GA came in at 4,000 crores, and let's say when they exited at let's say whatever 15, 16,000 crores. Now, obviously, from the IRR perspective, the 4 to 16,000 crores is substantially lower from the 25 to the 4,000 crore story. It's a 14, 15, 16, it's a 18, 19, 20% IRR. But the probability of this IRR is substantially higher. The certainty is maybe 100 times more, and the probability of getting there is 10 times higher. And the risk we are taking as individuals is also substantially lower. But on the flip side, in absolute terms, the wealth created is substantially higher. It's the IRR may be half, but the wealth creation is practically 4 times of what you did in the first 8 years. Obviously, from here, we believe over the next 5-10 years, if you can we believe there's a big opportunity to grow double from here. Now, it doesn't really, in that sense, bother us or kill us, whether it's 4 years, 5 years, 6 years. Those are things which we know only in retrospect. But honestly, from a probability perspective, seems the highest. From a risk-taking perspective, seems the lowest. and from an enjoyment perspective seems the highest. So in some senses, as you dig in your heels and get in there, I think an entrepreneur's journey becomes more and more interesting towards the second half as opposed to the first half. There's a great rush in the first half. There's huge amount of excitement, but in the second half, there's a huge amount of recognition and ability to build scale, and potentially also kind of leverage on a large amount of good work done over the last 12 to 15 years. So in some ways for us, as a team, we strongly believe in hanging in there and ensuring that we are able to kind of take best advantage of what we built out over the last 14 to 15 years. I think these are some of the four or five things we really, which really kind of stand out for me over the last 14, 15 years. Additionally, obviously, generally speaking, I hate change. So not that if there is change, I'm ready to handle it, but I hate change as such. We love to see as little attrition of employees as possible, as little attrition of clients as possible, as little attrition of change in everything, right? But at the same point of time, I think we always believe that some things, if they happen for the good. And I think the first 60 seconds, the reaction is always a negative, but I think out of the next 9 months, it's always positive on thinking on how can we emerge better from what's happened over the first minute to 2 minutes. So overall, I think from a culture perspective, we strongly believe in keeping things constant, methodical, and very, very strongly believe incremental is exponential. There's really nothing called exponential for us. Everything which is incremental slowly becomes exponential. So I think these are some of the 5-6 things, Vikaas, I would like to share. Happy to hand it over to you and take it from there.
While listening to you for the last few minutes, 2 things have happened, Karan. One is, I think, typically as an entrepreneur, one of the things which is required is optimism to run the business. And I think you come across as a guy with a half glass full approach, which each of your adversities and where you learn from them. The flip side is you preempted almost all my questions, which me and Madan were going to ask you. So, I think I'll just probably scroll through the rest and see whatever is remaining. In fact, one of the things most people are very keen to know about, is you talked about the business sense, the numbers part of it when you started looking at this entire business. But what was your vision, considering the landscape there? What did you want to set up? What drove you to becoming an entrepreneur, apart from the fact in terms of the ratios that you're talking about in terms of money making? What was the vision which you had?
So Vikaas, I'll be lying to you if I said I had some great vision to start. But yeah, one thing I was clear about, I think at that point, I think in 2006, Mr. Premji had sold a large stake in Wipro, and he had basically called up Uday and said that why don't you all look at doing something around setting up a family office. And I think that got passed on to me. And I spent a lot of nights between 2006 and 2007 on studying what a family office is. And that's really when Bank of America Merrill Lynch in 2007, 8, 9 in the US was making the entire transition from being a broker dealer to an advisor.
Yes,
So I think
yes.
that made a lot of sense to me, and I thought that was the way the world was going to head. And eventually the relationship between a client and a wealth manager would need to be one where the friction in the relationship is least, and therefore you're being paid more by the client than by the manufacturer of the product. And I think I spent a lot of time on that. 2007, we actually got McKinsey to start working on it while I was at Kotak. But 2007 were heady days, and trying to move clients to from a product distribution model to fees never really happened. And in some senses, in 2008, I thought the larger firms would never do it, and I thought that was the right business model. So in some ways, I believe there was a large opportunity in 2008-9 to be able to go out and tell the clients that the only fee I'm going to earn is the fee from you. Obviously, there were no direct plans and stuff like that in 2009. So we had to set up a kind of a shadow P&L with the client. But in some senses, I think that was for me a big opportunity. And that was in some senses my calling. Obviously, it took a long time, nearly 10 years for for things like direct plan, RI regulations, and so on and so forth in India to come in. But honestly, I think in the US, the transition started from 2009. And in some ways, that was an inspiration for me to kind of look at things.
Super. Madan, over to you.
Thanks, Vikaas. Hi, Karan. Really wonderful to listen to your the journey, and very inspirational as well. I've always seen the IIFL as an institution which has come out with a lot of innovation when it comes to product as well as when it comes to the execution also in terms of distribution. How do you really manage to build this innovation-driven organization, which you also highlighted, right? That last 10% is very important. And how do you manage to continuously drive this innovation as a process? It's an incremental innovation, but it's a very important part of the work that we are doing. So what are the two, three things that you manage to do it rightly all the time?
Yeah, so I think it's a great point, Madan. I think to be honest, I think innovation is a culture. It's not really it's not really an idea. It's a culture, and innovation, very importantly, is a group of 8 or 10 people sitting together and thinking together. It's not really a product, right? It's not a science. And I think when we started out our business, in 2008, we were really struggling with two things in a big way, right? One was the market, and second was obviously the client sentiment of not doing anything risky at all. So I think I'll take those two examples to give examples of innovation, because innovation can be small changes. Right? In 2008, I don't know how many of us remember, but structured notes at that point of time were really popular, especially the capital protected structured notes, which were giving 1.4, 1.5 times the upside of the index, and the downside was capital protected. In those structured notes, obviously there was an upfront distribution commission of 1.5–2% to the distributor. The note was quite simple. 74 rupees was going into the bond, which was accumulating to 100 rupees after 3.5 years. The remaining 26 rupees was going to buy a call option on the index, which was broadly costing 20 rupees, and therefore the 26 rupees was giving you a 1.3 times upside on the market. It was quite simple. The trade was quite simple. The small innovation we did, because we had to attack the market, is we moved away and we told the manufacturer of the product that we won't take the 1.5–2% upfront. We will charge the client 0.5% a year. What that did is it increased the inbuilt commission from 26 or the inbuilt amount of money left to invest in the option from 26 rupees to 28–29 rupees. And suddenly we were able to take the participation from 1.3, 1.4 to 1.5, 1.6. Now we were able to obviously attract a huge number of clients, and we ended up doing the highest ever structured note trade in 2008 as a new firm with around about 11–12 people. Now, not something which can't be copied. It can be copied. Okay, so the next product had that innovation, but you get a head start, and that's something which is very, very critical. A small other example, which is even more simple, LIC launched Bima Nivesh in those years. And at that point of time, nobody wanted to touch anything but doing absolutely 100% safe bonds. And I don't know if you remember, but it was a 2,500 crore issue. It was giving a return of, if I remember correctly, I think 6.95%. And you were getting a 5-year insurance of 5 times the amount, for which maybe you're getting 10–15 basis points of mortality. So effectively with LIC risk, you were getting 7.1% post-tax. Everybody was obviously a broker in the house for everybody. And that 2,500 crores kind of got sold in 4 or 5 days, right? It got oversubscribed. At the same time, NABARD did a bond. It was a deep discount bond, notified bond, and therefore it was taxable at 10% at the end of the end of 10 years, maturing in 2019. And that bond effectively was at an 8.62% yield, but it had no distribution commission for anybody. The issue actually developed at ICICI Bank. So ICICI Bank was left with around about 1,000–1,200 crores of NABARD. Now, effectively on a post-tax basis, NABARD was ending up giving the client 8.807 post-tax, okay, as compared to Bima Nivesh, which was at 6.95. Okay. Now, obviously, NABARD has the same risk as LIC, and LIC has the same risk as NABARD, right? There was no difference in risk. So what we did is we essentially took NABARD to clients instead of taking LIC. And that became a big innovation, right? That allowed us to acquire at least 80–100 clients. And as life was to have it, LIC actually, out of that Bima Nivesh money, actually put 500 crores into NABARD. So they took it at 6.95 and effectively ended up investing it at 8.62. But all I'm saying is innovations can be as small as this. It really doesn't need to be something phenomenal. But we have to sit into it and think through it. And at some point, at some point it becomes a culture. And then you keep optimizing the smallest thing you want to do.
Really get it. I think the team approach as well as looking at I think you put the risk reward of two products in a very, very simple manner, and that reached out to the investors in a very nice way. I think that really worked. So right now, as we said today, and look at the alternate space is kind of getting a lot of attraction given what the kind of products that we can bring to the investors. Recently, high yield credit is also looking at it as a great opportunity. From your point of view, what can define this alternate space in the next coming years of 3 to 5 year time period? 2-3 things that can really redefine this alternate space, or it will be the same products which will scale up in your opinion?
No, so I think globally alternates really 4 large categories, for the lack of a better word. I think private equity continues to be a fairly large category. Credit is very, very large. Third, obviously, you've got yield assets, which will include all the REITs, InvITs, all the renewable platforms, and so on and so forth. And fourth, to a certain extent, very, 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 very early in India, but you'll have quant, long, short, hedge funds, and so on and so forth. These 4 are going to be a large categories. I think credit in India was largely non-existent till 31st March this year, because obviously we had a preferred tax treatment for mutual funds. So it just didn't make sense to do a 13-14% structured credit trade, where post-tax you were left with 7.5-8%, and on a 10-year GSEC you were left with 7% post-tax. So the risk reward just didn't justify going out and buying a structured credit fund as opposed to going and buying a sovereign, quasi-sovereign paper. Obviously, post 31st March, that's changed, and now everything is equally taxable, and therefore there's really a 400-500 basis points flip up for the clients to take that incremental amount of risk, and therefore I think credit as a category will disproportionately grow as it's grown across the world. Obviously, there'll be different spaces for the credit. You'll have some in AA+, A-, at the 9, 10, 11% range. You'll have the structured credit or 13, 14, 15. You'll have the special situation. There will be a space for everything. But I think credit is early stage, mid stage ideas. Obviously, as a firm, you have to take a decision whether you want to be the operator of the asset or you want to be a financial investor. We more often than not are financial investors and not operators of the asset. And thirdly, then you'll have all the yield assets, which will range from commercial assets, REITs, InvITs. It could be road assets, it could be real estate assets, it could be transmission assets, it could be energy assets. On the long short, obviously, there's continues to be a big tax arbitrage where listed equity is taxed substantially more favorably, and therefore I think long short as a category is kind of right now handicapped by tax. So I think outside that, I think the top first 3 categories which I spoke about are here and now in India.
You actually mentioned about the structured products in the last cycle, right? When you actually gave an example of how you a bond plus a warrant sort of a structure. I remember those days, a lot more such products used to come, but now we don't think that kind of a depth is there in the market. But do you think market is again warming up to this, Karan?
No, I think. See, the structures were quite simple, but it largely kind of drew upon from a lot of the MNC banks looking at this as a liability raising exercise, and I think that's not really there, because most of the banks, including Citi, Barclays, and so on and so forth, have kind of wound down the balance sheets from that perspective in India. They're not really being a retail side liability balance sheet. So in terms of issuers, essentially the people who want to build a retail liability side balance sheet, and that universe is fairly small now, and therefore you're not seeing those many issuances.
With the alternate platform becoming bigger, you think the directly you can take it to the investors, that opportunity now comes in with this for this kind of a structured products?
So No, so I think alternates as a category is going to become fairly large. I think even if you look at India and you look at globally, I think alternates end up being close to 25 to 35% of the AUM, but typically 60 to 65% of the revenue pool. Mutual funds end up being close to around about 35-40% of the AUM and potentially 25-30% of the revenue pool. ETFs obviously end up being 50%, 40% of the AUM, but 5 to 10% of the revenue pool. So I was saying even in India, the mutual fund pool approximately 42, 43 lakh crores and revenue pool of around about 32,000 crores. And the alternates pieces moved to around about give or take 7.5 lakh crores of commitment and 4.5, 5 lakh crores of drawn down amounts, which puts the revenue pool close to already close to around about 7.5, 8,000 crores. So in a short span of time over the last 5 to 6 years, we've already seen the revenue pool for AIFs becoming fairly large. It's nearly 25-30% of the overall revenue pool. So I think as time goes by, India will follow a more or less the same trajectory which has been seen in most of the markets. So the next 10 years, I think there's a lot of scope for alternates to grow both in terms of AUM as well as in terms of revenue pool.
Thank you, Karan. Really loved interacting with you. Over to you, Vikaas.
Okay, I think there are a lot of audience questions now coming in, and I also have a lot of questions at my end. But in the interest of time, I'm straight away going to jump into audience questions, Karan, if that's okay with you.
Perfectly fine.
Yeah. So I think I'll start off with a question. In fact, Vicky Talaja wanted to know your views on the wealth management business in India, which I think you've given a fair idea. But I also want to talk to you about the vantage point from where you sit, the wealth management business and the asset management business both. How do you think these complement with each other? If you could just give us a quick perspective.
No, so I think from a industry perspective, I think both the businesses have some tailwinds and some headwinds in some senses, right? Because the tailwinds in the business obviously is the size of the market is phenomenally large. I think it's a business which benefits from three things automatically. I think there's a natural mark-to-market benefit of 7 to 8% every year. The second benefit of 7 to 8% is just broadly the growth in financial assets. And I think there's a disproportionate growth, especially in India, just given the GDP growth rate, we'll see financial assets broadly grow at anywhere from 1.3 to 1.5 times the growth of the GDP, because generally speaking, the conversion of real assets to financial assets also substantially higher. And third, obviously, you've got the entire geographical width, right? So general awareness and growth across the country is substantially higher. On the asset management side, obviously, operating leverage for most people will kick in. But overall, I think headwinds will continue to be also there. I think generally speaking, talent is a challenge. General expectation of getting the cost to income right for most platforms is a bit of a challenge. And thirdly, I think sometimes all of us go ahead of ourselves, and we end up doing things very, very quickly and in a hurry, and that kind of sometimes puts us back a bit. But overall, I think it's going to be a market where over the next 10, 15 years, the winners will be the ones who don't end up making too many mistakes, because the market's going to continue to grow. So we'll have to be a little patient. I think it's not going to be a one-way street, and there will be constant adjustment as we go along. But overall, I think over a space of 10 to 15 years, I think 12 to 15% broad growth in profits and a 15 to 20% growth in revenues is something which all businesses on the wealth and asset management side should be able to easily guide towards.
So, Karan, I'm going to end with three questions, quick fire questions here. Okay. Amar Company asks you, what are your views on the current valuation of fintech firms, both private and listed? Is it headed the way of edtech, or is there still some runway left?
No, so honestly, I think fintech is got some way to go. Honestly, the only two monetizable models in fintech have been brokerage and lending. I think lending, obviously, I would love to see a full-fledged cycle. We've not seen a full cycle yet. Brokerage, I think there's no doubt it's kind of come a long way. Whether it's Angel, whether it's Zerodha, whether it's Grow, I think all three have shown that there is a definite monetizable model there. In terms of financial advisory and mutual fund distribution, I think there's still some way to go. I'm not sure of the final business model there. I think ease of execution is definitely a value addition. Better analytics, better choice, better product selection, better financial planning, all of that is there. How can we convert it to a monetizable model is something which we'll have to wait and see.
Wonderful. This is a very interesting question from Suraj Singhal. And I think it epitomizes a lot of questions which come in at this point of time.
Right.
It talks about the fact that a lot of people, he's talked about the mutual fund category. So I'll just take that category, that there's a lot of impetus to get people in to a mutual fund. But what are the red flags one has to look at to exit that category or exit a particular mutual fund strategy? What would be your views on that?
No, it's similar across all themes. I think number one, obviously, I think every strategy has a certain size it can kind of absorb, right? So I think for us, one red flag is when it crosses a humongous amount of size, because no scheme by itself has an absolute performance benchmark. It is always relative, and I think the ability to outperform relatively will be inversely or conversely difficult and inversely proportionally related to size. So size, I think, for us is important. Second, we typically would not like too many schemes which end up giving very high returns or very low returns. We would like some bit of consistency, because in a journey from A to B, I think the volatility ensures that the person gets out of the fund before he reaches point B. So point B will come for sure, but the volatility more often than not ensures that the person is not able to reach point B. So for us, honestly, I think the standard deviation and the size of the scheme would be very, very critical. And thirdly, obviously, there will be some strategies as time goes by, which at a certain size, passives will become more interesting than actives.
Interesting. So the last question, and this is a blend of a question which Mahindra is asking as well as somebody who'd asked it earlier. What do you think a mid-sized wealth management firm should do at a strategic level? Should they invest further for growth, or should they remain boutique and manage and maintain their cash flows right now? A, and B, what is your challenges? What do you think are the challenges to retain AUM in wealth management firms?
Wow, both are tough questions. No, I think mid-sized wealth management firms, it's a real tough one. I think both wealth and asset management, by definition, honestly, at the heart of it are cash flow businesses. They're not valuation businesses. Okay? So I think for it to get value, you really need to optimize at scale and standardize at scale. Okay, I think, and that will not happen till you get a lot of scale. And I think that number of scale is always changing. I think globally, it's fair to say any business less than $10 billion will not be able to optimize and scale. I think in India, that number may be potentially 4 to 5 billion. I think any business south of that, I think I love the business. It's a great relationship business to perpetuity, but I would focus more on building healthy, robust cash flows rather than try and worry about the value of the business. In terms of the AUM, I think pretty much the same thing, honestly. I think build an investment policy statement, walk through the risks and ensure that the review of the investment policy statement is done every month, every quarter. I think as and when the client fully understands the logic of our decisions, I think the ability of the client to stay invested is that much higher. And therefore, in some senses, the ability for us to retain our AUM is that much more. Just the last point in terms of the AUM itself, globally, out of 100% reason for wealth management firms to lose AUM, the largest reason is not performance. The largest reason is not relationship manager change. These two are actually the bottom two reasons. The largest reason for change is change of money from one generation to the other. So that accounts for 55 to 60% reason for change of wealth managers, because the son or daughter always thinks that the father could have done better. If he invested everything in equities, he could have been safer. If he invested everything in debt, he could have been taking a little bit more risk. 20% is service, and last 20% is actually subdivided between change of relationship manager and performance. So honestly, if it's about retaining AUM, I think eventually you'll have to get the first 80% right.
So, Karan, I think if you're okay with it, I think the Mr. Mahindra who asked this question asked the best question. There's a prize for the best question. Is it okay if we give him the prize for the best question?
Absolutely.
Congratulations, Mr. Mahindra. We'll be in touch with you. Karan, it's been an absolute pleasure to have you here. I mean, I was just looking at the time. It's been an hour. We just flew past. A lot of insights, a lot of pearls of wisdom for a lot of people around here. Thank you so much for your time, for being here, and it was really nice hosting you.
Thank you, Karan.
Thank you. And apologies for a little bit patchy connection. Thank you. See you. Bye-bye. Thank you, everybody. Thank you.
Thank you all. Thank you for the insightful session.